Okay. So now let us do this problem, examination problem, and based on Ind AS. So this will give you the clarity regarding how the problems are asked in examination and how do we are going to solve it. So you can come to this problem. Following are the financial statements of Abraham Limited. Balance sheet, equity liabilities, shareholders funds, reserves and surplus, non-current liabilities, long-term borrowings, deferred tax liabilities, current liabilities, trade payables, short-term provisions, other current liabilities. Non-current assets, fixed assets, deferred tax assets, current assets, inventories, trade receivables, cash and bank balances total. One thing you need to be very clear. You are not need to worry about preparation of balance sheet P&L. Don't worry about tallying balance sheet. They would have given balance sheet P&L account to you. What you need to worry about is the form of presentations. The name we use. For example, we don't use the word fixed assets. We use the word property, plant and equipment. We don't use the word reserves and surplus. We use the word other equity. Those are the kind of things you need to keep it in mind. And one more small point, like deferred tax liability we have, deferred tax asset we have. Usually we will set it off unless we know that it is under different statute where entity cannot set off. We usually do it on net basis. Things like that to be kept in mind. So you don't worry about tallying the balance sheet, whether it goes to P&L, whether it goes to balance sheet. That you need not worry. What you need to keep it in mind is the format, the structure, the terminology. Statement of profit and loss, revenue from operations, expenses, employee benefit expense, operating cost, depreciation, total expense, profit before tax, tax expense, profit after tax. Notes to accounts, reserves and surplus, capital reserve, surplus from P&L, opening balance, current year addition, reserve for foreseeable loss, total. So 550 plus 950, that is 1500. Then reserves for foreseeable loss 400, total 2400. Long term borrowings, term loan from bank, total. Deferred tax asset, deferred tax liability. Other current liability, unclaimed dividends, billing in advance, other current liability. Trade receivable considered good, outstanding within 6 months. Considered doubtful, due from past 1 year. Provision for doubtful debts, total. Additional information also given. Share capital comprises of 100 lakhs of rupees 10 each. Term loan from the bank for 5,700 lakhs also includes interest accrued and due of 700 lakhs as on reporting date. Reserve for the foreseeable loss is created against a service contract due within 6 months. Inventory should be valued at cost 1,500. NRV on the date is 1,200. A dividend of 10% was declared by the board of directors of the company. Accrued interest of 300 lakhs is not booked in the books of the company. Deferred tax related to taxes on income are levied by same government tax laws which can be set off. Identify and report the error and misstatements in the above extracts and prepare corrected balance sheet and the statement of profit and loss where required relevant notes to accounts with explanation thereof. So they have given the P&L, they have given the balance sheet. We have to redraft the P&L, redraft the balance sheet with the proper format and the proper terminologies. Read the problem once more. Okay, so let's discuss one by one. uh, let's just go through with the format overall. Let us look at the balance sheet format. Then we'll rewrite the theoretical sentence misstatement reports. Then we prepare the corrected ones. Okay, first, we don't use the word shareholders funds. You use the term equity, and we don't use the words reserves and surplus. We use the term other equity. Let's mention those things. Please mention it. First point. Uh, the terms to be replaced are, instead of telling one by one, we'll give in a columnar format. Term given, uh, new name, the correct name. The term as per schedule 3. The term given in the question, term as per schedule 3. They have given the word shareholders funds, and also asset will come first. Okay, that also we can write it. So they have given shareholders funds, and as per schedule 3 we use the term equity, and they use the term reserves and surplus, and here we use the term other equity. They've used the word fixed asset. Here we use the word PPE, plant, property, and equipment. Short form you can use now. Long term borrowings, assets, non current assets. Okay, so the second point you can mention schedule 3 division 2. As per schedule 3 division 2, asset side, asset is shown first, and equity liability will shown below. Equity and liabilities is shown below. Then one more thing what is missing is they have not given the heading of financial assets, financial liabilities. Under current also, non-current also, for assets also, liabilities also, the breakup of financial asset liability not given. There's one more problem here, error. Let's mention that. Classification of financial assets and liabilities. Not shown, not reflected, not shown separately, not shown separately, not shown separately, not shown separately. Then deferred tax asset and liability are shown separately, and they said, okay, let's do one thing. Let's read in this format. Any points are required in that additional information. Share capital comprises no problem. Term loan includes interest accrued. Interest accrued is not shown under borrowings. That is shown part of current liabilities, but they have shown together. You have to show separately. So you can mention that interest accrued to be shown under current liabilities, not under loans, not under borrowings, to be shown under current liabilities. Okay. Then reserve for foreseeable loss is created against service contract within 6 months. So there is a contract on which you might incur loss. You have a contract, so you're accounting for provision now. So this is, it's called as what contract? Ind AS 37. Executory contract? No. What is this contract is called as? The where you have a contract on hand and your benefits is lesser than cost. Cost exceeds benefit. It's called as onerous contracts. So they are provisions, not to be shown under reserves and surplus. Reserve for foreseeable loss is not a reserve. It's a provision. So it should be shown under provisions. So that is one more mistake. So you can mention reserve for foreseeable loss should be shown in provisions due within 6 months. So you can say short term provisions to be specific. Okay. So share capital is fine, turmoil is fine, reserve is fine. Inventory should be valued at cost 1500 and NRV on the date is 1200. But inventory should be valued at cost or NRV, whichever is less. They have valued, should be valued, I think they have valued at 1500, but we should value at 1200. So we have to write down the inventory by 300 lakhs. Hope you written these 5 points. Next, inventory to be valued at lower of cost and NRV, lower of cost and NRV, and lower being 1200 in this case. So inventory to be written down. Inventory to be written down by 300. 1500 minus 1200. Okay. Then a dividend of 10% was declared by board of directors of the company. Dividend of 10% was declared. If it is declared before the balance sheet end, before the year end, it comes under a balance sheet. Otherwise, it is declared after the balance sheet date, it becomes non-adjusting event. It will not be shown in the financial statements. But any case, it should be disclosed in the notes to accounts. So declared dividend after balance sheet date, declared dividend after balance sheet date, to be is a non-adjusting event, is a non-adjusting event, non-adjusting event but to be disclosed in notes to accounts. But to be disclosed in notes to accounts. To be disclosed in notes to accounts. Okay. Accrued interest income of 300 is not booked in the books of account. So we need to record it. Accrued income, it comes under other income, and in the balance sheet comes under current assets, other current assets. So accrued income presented under other income in P&L and under current assets, other current assets you can say, under current assets in balance sheet. In balance sheet. Okay. Okay. So what else? Points. A deferred tax asset relates to same government laws. So that should be shown on net basis. Deferred tax assets and liabilities should be shown on net basis. Should be shown on net basis. Okay. And then also we have to show in the P&L account, EPS should be shown. You know, EPS from continuing operation, discontinued operation, basic diluted, that should be shown. That's not given. So EPS to be shown as part of P&L. EPS to be shown as part of P&L. As part of P&L. Okay. So let's prepare the notes to accounts first. Then we prepare P&L and balance sheet. You can even start from balance sheet also, because you know the format anyway amount you need not calculate, nothing to add separately, only the accrued income is there. But anyway, so we'll prepare the notes to accounts and then we can do P&L, then balance sheet. But for presentation purpose, balance sheet first, P&L account, and notes to accounts. So for examination purpose, you write notes to accounts first, P&L account next, balance sheet next, they accept it. But practically, balance sheet we write, then below that P&L account, then below that notes to accounts will come. So, but if you want to write even in examination like a practical point, no problem. You write the balance sheet format. Don't write the amounts. You write the P&L account format. Don't write the amounts. Then you write the notes to accounts. You get the amounts. Keep filling up the P&L balance sheet. You will be presenting in the regular format. So anything in examination, everything is accepted as long as numbers are correct. Okay. So let's prepare notes to accounts. Okay. Note 1. I'll say deferred tax. I'll use the short form DTA. In the exam, you can write full. DTA 700, DTL 300. So DTA net 400. You can mention all rupees in lakhs. Instead of writing one by one heading, you can give like that. Ideally, you should have given plant, property, equipment information also, which we don't have. So let's not worry about it. Let's do trade receivables. Note 2, trade receivables. Or, yeah, uh, fine. Trade receivables. Okay. So what information we have on trade receivables? Huh. Considered good, outstanding 6 months. Considered doubtful for past 1 year. Provision for doubtful debts. Let's show that. Trade receivables for 6 months, that concept is not there. So trade receivables considered good. 1065. And for which doubtful, you know what we use the term as per Ind AS 108 for 109 financial instrument. We use the word trade receivable with significant increase in credit risk, credit impairment. We just say increase in credit risk. Trade receivable with significant credit risk. 40. Then provision for doubtful debts. Five. So 1100. It's more than a year. Should we provide fully? No. Just because it's outstanding more than a year does not mean you have to provide fully. We don't say that. If it is more than a year, we have to check for uh, lifetime losses. To what extent it is receivable? Lifetime losses based on your expectation. Lifetime losses we subtract. Does not mean if it is more than 1 year, we should make a provision fully. That's not what Ind AS 109 says. Ind AS 109 says for trade receivables for lifetime, you know amount is not receivable, make a provision today itself. If you know it is not receivable, does not mean you have to provide for full amount. That's not the meaning. Hope you got the point. Okay. Long term borrowing, note 3 I'll do. Long term borrowing. They have given 5,700. 700 is accrued expenses. You can take it out. You can simply say 5,000. Actually, this notes is not required. Okay. Note 4. Other financial liabilities. So what and all we have? Other financial liabilities. Unclaimed dividends. Interest on loan will come. And those things, billing in advance and other current liabilities, that is other current liability, not a financial liability. Billing in advance, your obligation is not to pay cash, your obligation is to deliver goods, so that will come in not as a financial liability, it's a non-financial liability. Other current liabilities also other current liability, but unclaimed dividend is a financial liability. But one more financial liability will come, that is interest on loan. That 700 what is subtracted from the long term borrowing, that is shown as part of other financial liabilities. Be very careful. What is other financial liability? What is other current liability? Other financial liability will include dividend payable and interest payable because obligation to pay cash. Other current liability means which are not financial in nature. That's what we call it as other current liabilities. Anyway, so here we have unclaimed dividends, 10, and interest on term loan 700, total 710. Okay, hopefully I can go further. Next, short term provisions, note 5. 300. Oh, provisions, yeah, okay. Short term provisions 300 given, but that thing which is contract due in 6 months, reserve for foreseeable loss will also come here. Reserve for foreseeable loss 400, total 700. Note 6, other current liabilities, that for that billing in advance and other current liability will be part of this. Billing in advance and 150, and others, just say others, 40, 190. Then we'll write one note for dividends recommended for the year. It's not recognized but disclosed in the notes to accounts. Dividends recommended for the year. What rates? 10%. At 10%. That is 10% on face value. What is face value? Face value of 10 each. So 10 into 10% becomes 1 per share. That is rupee 1 per share. Okay. So these are the different notes to accounts. Let's prepare balance sheet, a P&L, a statement of changes in equity. First, let's prepare P&L. Statement of profit and loss. Okay. Statement of profit and loss. We will do the revenue from operations. Like whatever particulars. Note number if you have any rupees. Rupees in lakhs. Revenue from operations. No, we don't have anything. 6,000. Other income. That accrued income we have. That number 300. So total income 6,300. Then we have expenses. We have operating cost. Oh, we don't have information on inventory actually, right? Changes in inventory. We don't have information here. Okay, at least at 300 will show it. That's it. What else I can do? Changes in inventory. Do we have operating cost format in P&L accounts? No, we don't have operating format, operating cost actually, but institute also have given operating cost. The format operating cost is not there, but these are all the minimum standard requirement. If you want to add a new line, you can still add it without leaving water existing line. Anyway, so there is no purchases here. So I don't have to write that line. Uh, Changes in inventory I write. That is write off. Only that number I can write. Written down by 300. Only that number I can write. Then employee benefit costs. That is there. 1,200. Depreciation. Finance cost is not there. Depreciation. 450. I'll write operating cost. Other expenses, instead of that, I'll write operating expenses. That's fine. You can still write operating expense. More line item, you can add it. Operating cost. 3199. So total expenses. $5149. Please confirm the amounts are fine. So we get profit before tax. We don't have to worry about continuing operation, discontinuing operation, exceptional items because none of those informations are there. You need not write it. 1151. Then tax expense 201. We don't have information on deferred tax separately, current tax separately. Just say tax expense. Profit after tax. In fact, the amount given in the problem and this profit after tax perfectly matches in spite of adjustment because two adjustments were there which were equal set of each other. 300 rupees other income we have taken and 300 rupees inventory of written down. So one income, one expense, both got nullified each other. So a profit same as what is given in the problem because of that coincidence. Mutual 300 set off will be compensating error. Equal amount, one for income, one expenses. Tax on accrued income, you can take it, but as I told you on inventory write off also will come, right? So on accrued income also tax impact will be there, and inventory write off also tax impact will be there. So that level they will net nullify each other. So no impact on tax also, nothing to worry about. So you get 950. Okay. Then EPS also should be shown. So EPS, divide this by number of shares. So 950 divided by number of shares. How many number of shares are there? I think 10 lakh. So or 100 lakhs. I think 1000 lakhs by 10. I think 100 lakhs. 1 crore is there. So divide by 100, you get 9.5. Basic also, dilute also, both of them. Basic and diluted. Both are equal. Both are 9.5. Okay. So let's prepare a statement of changes in equity and then we prepare balance sheet. So it is done till here. Statement of changes in equity. First we do for share capital. And then we go for other equity. I mean equity share capital to be specific. Again, everything rupees in lakhs. Then we say opening balance, balance at the beginning, then changes during the year, then balance at the end. We don't have any information, so full amount will take 1000 beginning, changes 0, closing thousands. Then other equity, individual item we have to provide. So we have particulars. We don't have any OCI items. We only reserves and surplus. Reserves and surplus. We don't have any OCI items. So that we just, I'll write it blank, but I'll write OCI items are not there. In fact, you can ignore it. I'm writing so that you understand. OCI item will follow it. Under reserves and surplus, we have two items. One is the retained earnings and then capital reserve. Capital reserve, retained earnings. So opening balance, balance at the beginning. They have not given capital reserve whether opening balance was there or created during the year. I'll that opening balance assumed. Opening balance was there. You can assume it's created in the current year also. Retained earnings. Retained earnings. Reserve surplus I can do. Opening balance 550. Okay. OCI item and all nothing is there blank. You can ignore the OCI column. I'm writing only for your reference. Then income for the year. Total, let's can say income for the year, total comprehensive income for the year. Capital reserve nothing. Retained earnings 950. Or you can give actually one total also. Okay, I'll eliminate OCI items. I've shown you for your reference. You can write blank. I'll write one total for reserves and surplus. So 1050 was the opening, 0 and 50. The 950 is the addition. Balance at the end of the year. Balance at the end. So 500 here, 1500 here, 2000. Okay. So after this, we will prepare the balance sheet. You can also mention these are all for the year ended as on that means you can mention. Okay, done. Let's go for balance sheet. Balance sheet. If closing stock value is decreased, shouldn't we increase the profit? Oh, fundamental question. If closing stock values decrease, profit will decrease. It will not increase the profit. Closing stock is less. Means what will happen to cost of goods sold? Opening stock plus purchases minus cost of goods sold. If cost of goods sold is less, then if closing stock is less, cost of goods sold will increase. So sales minus cost of goods sold, profit will decrease. But moreover, what is the main important concept of Ind AS 2? Cost or NRV, whichever is less, is based on the concept of prudence principle. We want to show less profit. NRV is less, that means when we sell the asset, we make that loss. That loss is shown this year itself. That is the basic concept of Ind AS 2, isn't it? So when the closing stock is reduced, prudence principle, you will have a loss to be provided. So current year, profit will reduce. Anyway, no problem. So let's go to the balance sheet of Abugam Limited as on 31st March 2019. Balance sheet on 31st March 2019. You can write note numbers, rupees in lakhs, assets first, PP. In the exam, you write for total. I'm now writing property, plant, equipment, 5,000. Notes to account, deferred tax. Oh, this is actually non-current, under non-current. Under non-current assets. So deferred tax note also we have net asset, which is 300. Then we have current assets. Under that, inventory is first. It is cost or NRV, whichever is less. It is 1,500, I think, in the balance sheet. So we have to show 1,200. Then we have financial assets. Under the trade receivables, we have note 2 also regarding this, 1,100. Cash and cash equivalents, as it is, same amount will come, 300. 2,000, sorry. Then other financial assets are there. That interest accrued receivable, other financial asset. Interest income accrued, 300. It's a financial asset, receivable in cash. Right to receive in cash, financial asset. So total 9,900. Equity and liabilities. Under that, first equity share capital, thousands. Other equity, total we have written 2,000. Then lender liability, we have non-current liability. Under that, financial liability. Under that, long-term borrowings, loan pending, long-term borrowings, 5,000. I think we have a note also, note 3. Okay, so then current liability under that financial liability, under the trade payable, 300. Other financial liability, that dividend and all was there, unclaimed dividend, 710. Then we have short term provisions. I think we have a note. Note This was note 4, note 5, I think. Note 4, 710, note 5, 700. Then other current liabilities, note 6. 190. Total 9,900. See, if the balance sheet is tallied, anyway, it's same thing from the question only. So it's about identifying the mistake, and the format is all about this problem. You don't have to worry about preparation of P&L balance sheet. Tallying balance sheet is not a problem. If you want, you can just underline these headings: current assets, non-current assets, equity, non-current liabilities, current liabilities. Okay, fine. So this is how examination question is very simple. The format you have to know it, the standards, whatever they say, you have to apply it here. So it's a kind of revision of all other problems, all other standards in one chapter. Okay, hope it is done.